Hi, I'm Shaun Clearwater with Aspen Creek Financial and the Stewardship Institute. Wanted to touch real quick on one of the hottest topics with the majority of people that we meet with is taxes, whether it's long-term or short-term capital gains, income taxes, or just paranoia or fear of what the future tax rates might be, particularly when you're thinking about retiring. For those that are, right at the inflection point of going from working to retiring, you can kind of get a feel for what the tax environment might look like. It might be fairly similar to where we're at right now. But for those that have, 5 to 35 years before they retire, not knowing what the tax environment will be like can bring quite a bit of anxiety. So we try to look at some of the tools that are available in the financial marketplace to alleviate the risk of not knowing what the tax environment will look like. And the best way to do that is to look at the options and then figure out whether one or more of them might fit your particular situation. And then we can evaluate, how much to do in one or the other, and maybe it's a combination. More often than not, it is. So just to mention by name a few of the ways that you can go about mitigating future taxes. You can, of course, utilize what's referred to as a Roth IRA. That's a product that you put after tax money into, and because you paid tax on it today with your current tax rate, all of the money that goes into that account is given an opportunity to grow at a tax-free, in a tax-free place. Meaning, when you go to pull that money out in retirement, you won't have to worry about what the tax rates are. You do have a little bit of limitation with respect to flexibility by virtue of the age restriction. And currently, the IRS is limiting access to growth of that money without penalty to be 59 and a half years old. So if you're looking at accessing money early for retirement without having to pay a penalty, you need to wait until you're 59 and a half. There are some ways to sneak through that. There's a methodology called a 72T, where it allows you to access all of the money without the penalty, but it has some requirements that you have to meet with respect to equal distributions for a number of years and things of that nature. So there's always a way around something. It's just a matter of whether you like the result or not. And we can talk through that with you in a one-on-one situation if you find yourself in that scenario. So Roth IRAs are a great tool to utilize. It certainly should be part of everyone's portfolio if at all possible. The traditional IRA methodology gets you a deduction on your taxes now, but you'll be subject to whatever the tax rate is in retirement when you do start pulling that money out. So for those that think they might be in a lower tax bracket in retirement, that's a great solution because you can get a deduction now and you'll pay less on taxes in retirement than you would if you were to be in the Roth IRA scenario where you're paying taxes today but not tomorrow. There are a number of different analogies that I learned over the years to try to help illustrate this concept. So if it's remotely confusing, don't worry. I'd be happy to give you one or more of the analogies that I learned over the years to try to help that concept sink in. There's a farmer and a seed analogy and a number of others. So be happy to go through that with you on a one-on-one basis. But Roth IRAs are a great solution for future tax protection. So not having to worry about what the tax rates are in the future. One of the other tools that are available in the marketplace is utilizing what I like to call investment grade life insurance contracts. As soon as you start talking about life insurance and investments, there's a lot of dispute in the marketplace and in the advisory practice, and it's kind of analogous to whether somebody likes cilantro or not. Some people love it, some people hate it, and so I prescribe to the thought process of it depends, and so not. A life insurance contract is not always appropriate for any one situation, but for the majority of people, I think it's highly worth considering. The biggest problem that we find in this environment, though, is that not all investment grade life insurance contracts are made equal. Each one is unique. It's kind of like shopping at Costco and finding a product there and trying to see how it compares price-wise to where you could get it from another store. But conveniently, you can't find that exact product more often than not somewhere else. So you'll never know whether you're getting a really good deal unless you trust that more often than not, Costco is offering a high quality product at a good price. So with myself and my advisory practice and those and the majority of the agents with Aspen Creek Financial, we find that life insurance contracts can be a really good tool for most families and even some business owners. So it has a lot to do though with how you set it up and how the advisor sets it up. So there are right ways and wrong ways to do it. So when you look for information about whether this is a good idea or not, I have books that can tell you how it's a good idea, and I have books that can tell you how it's a bad idea. So at the end of the day, it's really up to you to decide whether it's a good tool for you to utilize. But I'd argue that there are more cases than not where a life insurance policy can be a really valuable asset, not only from a protection standpoint, but also from a cash accumulation perspective. Because it allows you, if you use the right kind of product, it allows you to participate in growth in the marketplace without any of the risk. And I can show you ways where you can effectively get the life insurance company to pay you to keep the life insurance policy. So it is one of those scenarios though where you have to qualify for the policy. So not everyone can qualify for a life insurance policy. You could have health situations or scenarios or circumstances that prevent you from being able to utilize this type of strategy. And if that's the case, we have alternative solutions that might be worth considering. And it's just every situation's a little bit unique, and so we can go through those scenarios as they come up. But Roth IRAs are a great tool. Investment grade life insurance contracts are a great tool. And as I mentioned in one of my other videos, utilizing a private family foundation can also be a unique tool to help protect you from future taxes. You've got strings attached in each one of these situations, so I can draw out the pros and cons of each one of those. But taking a balanced approach and utilizing each of the tools that are available to you in the marketplace is really the best way to go. So each situation's unique, and they all depend on different circumstances, but that's what makes this job interesting for me, because it allows me to be creative and convey different concepts and the pros and cons to each. So thanks for watching.